So for past year, there has been a lot more questions from clients about their pension plan, and that's because of pandemic. There has been a lot of layoff or change of jobs. So people now finally have time to take a look at their old pension plan and also their new ones in their new job. And a lot of them are curious about what is actually going on inside and how that might impact their future retirement planning. So for this week's video, we're going to dive into the different types of pension plan, talk about what they are, the pros and cons, and also answer one of the most asked questions is, should I withdraw a lump sum from my pension plan or take the monthly benefit? So no matter if you're an employee trying to understand your own pension plan, or if you're an employer thinking about offering one to your employees, this video will be the right one for you. Now, just a reminder, as of today, the Manulife 2% promotion for 4 months in their checking account is still available. I've talked about this in my previous video. It's one of the bank I use as well. It has very little restriction and there's no fee to set it up. So if you're interested for a higher interest rate in your checking account, check out the referral link in the description below. Alright, now without further ado, let's get started. So in this video, we're going to focus on two main categories of pension plan, that is defined contribution and defined benefit. Now, I do understand there are other benefit package out there like deferred profit sharing or stock options in most tech companies, but they're not exactly pension plan even though they look very similar. I'm going to save them for a separate video because it's a different topic. So today it's just about defined contribution and defined benefit. So first, let's talk about the defined contribution plan, which is a lot more common in medium-sized to large-sized firms. Now, the aim for defined contribution is really to help you save the lump sum for you going into the future. So how it works is basically you and your employer both set aside some money per paycheck and it will deposit into a defined contribution retirement plan that is named under your name. Now, usually how much to contribute, it's a percentage of your base salary. So obviously, the more money you make, the larger the contribution will be going in from you and also your employer. Now, what's attractive about this kind of plan is usually it's a matching from your employer one-to-one. So meaning if you put $10 in, your employer is going to match you exactly the same. And this is also why if there's a defined contribution plan available, I highly recommend you don't opt out of it and at least contribute to the maximum of the matching just so you can fully take advantage of this, because that's basically 100% return of every single dollar that you put in from your paycheck. However, what separates this from the defined benefit plan is that for defined contribution, you have to be responsible for the investment choice yourself. So you have the freedom to pick whatever fund you want within the pension plan and you can manage it yourself. And because of that, performance will be unknown. And since performance is unknown, you also are not going to be sure how much exactly you're going to get until you get there. Now, if you keep contributing to it at 71 years old, just like an RSP, this plan will have to be collapsed and have to be changed into something else. So by then, you usually have the option to take the money out and convert into an annuity or a locked-in RIF if you want to defer tax. Basically, this is kind of like a build your own pension plan kind of thing with extra contribution coming in from the employer. Now, this actually sounds very similar to a group RSP, but don't be confused. Defined contribution is different from group RSP. The main difference is that defined contribution is governed by pension rule, while group RSP is governed by income tax rule. So what that means is when it's time for you to quit your job or you want to withdraw from both plans, defined contribution usually is going to have a little bit more restriction than your group RSP. And for the restriction you'll be facing, that's something we'll talk about at the later half of this video. So next, let's go through some pros and cons on both employee side and also the employer side. So as you can see on the chart on the screen right there, the pros for employee is that there is matching contribution. There's also flexibility in your investment choice. And since it's more flexible, you can choose your own funds, you do have the potential to grow to a larger amount lump sum versus defined benefit plan that we'll be looking at later. However, the downside to this is that investment risk do lie with the employee at the end of the day, and also the pension payout is unknown, so that's not something you will be able to calculate or predict. As for employer, it is a cheaper plan to set up than a defined benefit, and also unlike defined benefit, you don't have the responsibility to maintain the fund itself to make sure pension can pay out since it lies with the employee. Now, as of cons, there really isn't many, except I guess it's maybe people will see it as not as attractive as the defined benefit if you compare apple to apple. So that's defined contribution. Now next, let's look at the other one, which is defined benefit. So for defined benefit, because of, as you will see how high the cost it can be to maintain this plan, it is usually more common in the public sector or in the mega corporation like TELUS or Bell, etc. So occupations like nurses, RCMP, or firefighters, those will be people that have defined benefit plans. Now, there is another name for this kind of plan. People call it the golden parachute. And that's because the purpose of these kind of plan is to provide you a guaranteed monthly retirement income when you retire. So the employer and the employee still both contribute to it together, but investment choice rests with the pension plan, so you don't get to pick what to invest in. They will be the one that grow all the money for you in the long term. And that's because the benefit is pre-calculated the moment you started working. Now on the screen, you're going to see an example of what the formula could look like for your work. So as you can see, the moment you started working, it's very easy to predict what your benefit will be by the time you retire. Now, when it comes to calculating your pension benefit, there's usually 3 different ways of calculating, and it could be the final average, which is taking the last 5 years before your retirement and use that as a baseline to calculate your benefit, or the career average, which is an average of all the years you've been working in the company, or the last one that is the flat benefit. So it doesn't matter about your income, they're just going to give you a fixed amount per year that you've been working in. Typically, final average will give you the highest pension amount, while flat benefit will give you the lowest. But there could also be exception in some cases, depending on your overall salary trajectory. Now, typically for these kind of pension plan, benefit can start as early as 55 or later. As for pros and cons, you will see on the screen here. For the employee, the pros is that benefit is known in advance. Investment risks do not lie with you. However, the downside with this is the pension fund company itself may be insolvent, and that could affect your pension plan, or the company might change the terms on your defined benefit plan, and that might affect your retirement. Now, as for employer, the pros of it is that it can attract a lot of people into your company because, like I said, this is probably one of the best benefits you can offer to an employee. However, the downside is that this is also one of the most expensive kind of plan you need to pay to maintain, because the investment risk lies with you. So you have to make sure the fund it's enough to pay for all the people you're trying to cover. But no matter which plan you're in currently, usually one of the biggest questions is by the time you leave or you retire from the company, should you take the monthly benefit or should you just take the lump sum and go with you? Now, generally, when you leave your company, your pension plan has 4 choices that you can exercise. Number 1 is to remain in the same pension company and stay invested and then take the pension amount. Number 2 is to purchase an annuity, so which is similar to number 1, getting a lifetime payment, but with an annuity that you purchase, there's potential that you can add specific condition and terms inside that might be more beneficial depending on your life expectancy and what you expect in the future. Number 3 is you can transfer the pension to a new employer, and if they're okay, then it will be invested with their new pension fund. Or number 4, withdraw and transfer to a locked-in plan and self-manage. Now, typically, most people are going to focus on option 1 or option 4 by the time they leave their company. So those will be the 2 options. I want to dive a little deeper here and talk about the differences and what you should look for to consider each choice. Now, this dilemma is especially true for defined benefit because, like I said, benefit is known in advance. So you would need to compare what benefit you're getting versus the lump sum you can potentially get. But for defined contribution, it's a lot easier because you have been self-managing it for all these years anyway. So most people would just take the lump sum and then continue to self-invest in a locked-in account because they have been doing so anyway in the past. So if you have a defined benefit plan, usually these are some questions you might want to ask yourself when you're deciding. The first question you should ask is there any restriction on actually withdrawing the lump sum out from the plan? Do you even have this choice? For example, a lot of my clients are in the RCMP force. So for them, the pension plan actually have some restrictions. In order for them to withdraw a lump sum, they have to be either before 50 or before they have 20 years of service in the force. So you could be 50 years old right now. The next year, if you still stay there, you don't withdraw lump sum in your pension plan, then you can't do it. So that's something you want to find out first because you might realize you don't even have that choice. Now, the second question you want to ask is, well, even though you may be able to make that time limit or restriction, do you actually want to change your job or retire or quit just so you can withdraw the lump sum? So for police, for example, if they never intended to quit, they want to work until they're 60, then they don't need to consider this because they would have to be forced to take the monthly benefit. So the third question you would be asking is, what are the terms and conditions being offered in each option? So for example, take the RCMP pension again. If they were to take the monthly benefit, the pension, they would get a lifetime guaranteed monthly income in there. However, if they pass away, their spouse would only get the spousal survival benefit of 50%, so just the 50% of whatever you would be getting. And there is a child benefit of 10% up to 4 child max. And that usually is how defined benefit pension will go. If you take the monthly pension and you pass away, usually your spouse and your kids will get a much reduced amount. So that's something you want to figure out and take account for first. Now, on the other hand, the other option would be taking the transfer value, or more known as the commuted value, out of your plan, should there be no restrictions. So in here, the transfer value, it's going to be calculated by the pension company. It's an actuarial equation that the actuary will come up with and give you the amount. But for your knowledge sake, you should also understand how it's calculated and what factors are affecting this calculation. So for this equation, the biggest factor is your age, because that determines your life expectancy, and the interest rate. So basically with these two factors, they're going to ask themselves saying, okay, how much money do I have to give this person today? So they can take this amount and go somewhere else and get roughly around the same pension as what we would have offered them. So this is why you might hear people say that around these couple of years, because of how low interest rate is, the lump sum they will offer you right now, it's going to be a lot bigger than usual. Because of how low interest rate is, they would have to give you a bigger piece just for you to have a chance to replicate the same thing outside by yourself. And as we talk about later on, that could make it a lot more attractive to actually take the lump sum versus getting the monthly benefit. However, for this option, if you do take it, then you have to understand that there is going to be a portion up to a maximum amount that will be transferred to a locked-in retirement account known as LIRA. Now, a locked-in account is no different than an RSP account, with the exception that it's actually locked in. So you have to wait until you retire, and when you retire, you turn it into a locked-in RIF, and then you will get their monthly benefit from there, and you cannot withdraw more than that unless it's an extreme circumstance. So this is to ensure you will always have money coming in, which will act just like a pension plan. And if your pension is so big to a point where you go over the maximum amount, then the rest will be paid out to you. And if you have enough RSP room, you can park the extra amount inside RSP to continue to grow tax-free, and you don't have to pay tax on it. But if you don't have enough RSP room, then the extra amount will have to go into a non-registered account, which is basically not RSP, and you will have to be taxed on that extra amount as your income. So this is why when a client decides to take from the pension plan, one of the things we have to make sure is ask them about the RSP room, show us the proof on the CRA My Account first. And if the RSP room is more, then that's fine. But if it's less, then we have to make sure the client understands the upcoming tax liability they will have to face should they take this transfer. Now, how do you know how much is the maximum that you can transfer into a lock-in account? This will be based on something called the age factor that you will see on the screen here. So basically, depending on different age you're in, there is a different factor you will take to plug into an equation. So how it works is, let's say you're 55 right now, and you're being offered a lump sum of 600K, or you get 40K a year from your pension. If you choose to take the lump sum and transfer, then the equation will be 40K, which is your benefit, times your age factor 10.4 in this case, and it will be 416,000. So 416,000 will go tax-free into your locked-in retirement account. The remaining 184,000 will go to you. And if you have this much RSP room, then this whole thing will go into your RSP room. But if it's not, then the extra amount will be non-registered and you'll be taxed on it. So this is why RSP room could be one of the major deciding factor, because if your pension is a huge amount and the locked-in maximum is not that big, there could be a huge leftover that you have to be taxed on, which will shrink your after-tax portfolio that you can work with. So that's something you want to consider as well. But other than that, there are some other things we want to consider when we're deciding should we want to take out of our pension plan. Now, before we move on, I just want to let you know I've made a chart comparing the pros and cons of a DC and a DB plan, and also the pros and cons of taking a pension versus taking your lump sum. So if you want these summaries to go over yourself or share with someone, make sure you join my private Facebook group, which has a link down below. Request to join and you'll be able to download these pictures. So there are several factors we want to consider, but the one that a lot of people sometimes talk about is the 6% rule. Now, basically the question they're trying to ask is, the pension monthly benefit I'll be getting versus the lump sum I can withdraw today, is it going to be 6% or better? So for example, if you are going to get a $1,000 per month pension benefit at 65, that's what's being offered to you in your defined benefit plan, or you can take 160K lump sum right now. What you would do is take 1,000 times 12, which is 12K, divide by 160K, which will give you 7.5%. So basically, they're saying that if you take a 160K right now and you want to replicate this 1,000 per month benefit from your pension plan, which is guaranteed to you, you basically have to get a 7.5% return a year on that 160K for the rest of your life since 65 if you want to replicate the same thing. However, remember we just said that the transfer amount is largely dependent on the interest rate currently. Now, because of how low interest rate is, you're very likely going to see a much bigger transfer value, which makes getting the transfer value lump sum out a lot more attractive than trying to stick with the monthly benefit right now. But before you make any choices, there's also other things you want to consider and talk to your spouse or talk to an advisor and just to get the sense of things. Now, first thing you want to look at is there incentive when it comes to taking the transfer value? So sometimes my client telling me that their company is offering them a lump sum and a little bit more bonus on top if they're willing to take the transfer value and go right now. So that's something you want to consider. And sometimes the incentive could be substantial. Number 2 is your life expectancy. If you expect your life to have a shorter life expectancy, then it's probably better to take the lump sum because the monthly benefit, like we said before, will be reduced or gone if you pass away. Number 3 is your preference for control. Some people like to control their own investment, want to take things into their own hand because they believe they can get a better result outside doing it by themselves. Some people completely do not want to do it themselves. So that really depends on you. Now, if you don't want to do it yourself, however, you can consider hiring an advisor to do it for you. But again, control is something you want to look at. Now, next is your need for income versus the need to leave a legacy. Taking a monthly benefit will give you no legacy to leave for your kids because as soon as you and your spouse pass away, likely the benefit stops. Whereas if you take the lump sum and you invest on the side, you may or may not be able to replicate the same monthly benefit. However, you will always likely going to have a lump sum there that's being invested. So it's very likely that when you pass away, the lump sum, there's still going to be at least a portion of it that will be able to pass on to your next generation. Now, second last thing you want to look at is your other pension plan that you might have in place or other passive income that might be coming in. So if you're someone that have a very well diversified portfolio and by taking the monthly benefit, maybe it will put you in a income that's too high and it will face things like OAS clawback that we talked about in the last video. So you need to take into everything to make sure it matches what you're trying to do. Now, lastly, the thing to consider is how stable is the pension fund company. Like we said before, insolvency will affect the plan, so you want to pay attention to that. And most importantly, before you make any decision, make sure you discuss with either an advisor or a professional, someone you trust. So we should just go over the numbers together to really make sure you're making the best choice. Alright, so that's basically everything I want to go over about your pension plan. I hope by now you have a much better idea what kind of plan you're in and how that might affect your retirement planning. Or if your employer looking to offer one to your company, which one you might prefer to do. Now, I want to hear from you. Do you have your own pension plan? And if so, what kind of plan is it? Or is it some other things like stock options? And how do you feel about your pension benefit from your company right now? Let me know in the comment below. And also, if you like these kind of videos, I'll upload them 8:30 EST every Tuesday. So make sure you like and subscribe to my channel. Click the bell button so you get all the notifications in the future. Alright, this is Jackie Cook. I hope you found this interesting. I'll see you next week. Bye!